Good afternoon, Peter Garney from Saxo Bank. You're an equity market specialist. What sectors do you think are under and overvalued at this moment?
Well, so right now what we are seeing is interest rates going higher and higher. Since the Fed they changed basically their mind on inflation back in November in 2021, and what we have seen is growth industries, e-commerce, the crypto industry has come down, biotechnology, all these types of industries have come down quite hard. And what we see is working right now, and the things we like the most in this current environment is the commodity sector. Because the inflation we have and all the issues with inflation we have today has come from the supply side and the commodity sector. So the commodity sector, we really think that the physical world is actually coming back. So the commodity sector is something we like. We like the defense industry. It's not very ESG, but if you look at the military spending plans in Europe, the defense industry here in Europe will be a very high growth industry for the next 3 to 5 years. We like logistics because the world is moving away from China plus one strategy, which was essentially China and then a little bit of Vietnam. And it's now very clear, and you had the news the other day that Apple is now producing a pretty big part of their iPhone 14 in India. So we're moving towards a China plus three strategy where companies will pull some manufacturing out of China and into Indonesia, Vietnam, and India. So those three countries inside the emerging markets are something we think investors should pay attention to. And inside this deglobalization theme, which is one of the reasons why we like globalization, because the world has gone from 40 years of globalization, markets opening up. And right now we're seeing with the war in Ukraine that there is this tension in the world, and the US and China's rivalry is also increasing. And that deglobalization means that supply chains in the world will fragment more. And that means that global logistics firms will play a pretty big role in moving around, and it will become more complex. And we think that's a good thing for the logistics firms. We like India, I mentioned that already. And then we think the whole renewable energy, we think is a part of the market which will continue to be quite positive, because there's a lot of political capital invested in this, and Europe, given the war in Ukraine, has a massive need for becoming energy independent, and you can do that with oil and gas in the short term because of the energy crisis, but longer term you need to be more independent, and that you can do partially with renewable energy sources.
Okay, thanks. Lately, or recent years, we saw that high dividend strategies are very interesting, and they brought big positive results. Do you think they are not overvalued now? Maybe high dividend stocks are too expensive?
So we just wrote about dividend stocks the other day. So if you look at the performance year to date, dividend stocks are down a little bit more than 10%. If you take there's an interesting index called the Global Dividend Aristocrats. So that's companies that have successfully been able to increase their dividends for 10 years in a row. And these type of companies have done pretty well. And if you think about it, they are sort of part of the value segment of the market. So what has happened is that as the interest rate have come up, the discount rate on future cash flows has gone up. So the equity valuations are generally coming down. But those parts of the market that have a higher equity valuation, higher PE ratios, they're seeing a much quicker compression of their valuations, and therefore the bigger declines. If you look at the dividend stocks, they typically on average trade or are valued with around 10 to 12 in PE ratio terms, and the market is generally right now at around 17, and you have the growth segments trading at closer to 25 still. So if we continue to see interest rates go higher, which is what the Federal Reserve intends to do, then we think actually dividend stocks will continue to do better on a relative basis. That's very important, because we think generally equities will come down from current levels, but dividend stocks will do better on a relative basis and actually improve your returns, so they're not as bad.
Okay. So if you think equities could come down a bit, or maybe hopefully not, but maybe more, what could you recommend investors to do with their money if they go out of the market?
Well, we generally have the opinion that investors should maintain a long-term view and have long-term horizons. So what you could do right now, I think there are two things. So one thing is to acknowledge that what really worked well in the past 12 years are not going to work the next couple of years. We will have a decade with a structurally high inflation level. it is less about the growth industries. It's more about getting exposure to tangible parts of the economy. So infrastructure, logistics, we talked about that, commodity sector, renewable energy, everything tied to those things will do quite well. Semiconductors will do well on a longer basis as well. So we think it's time for investors, because a lot of private investors, they have a lot of technology companies that are not very profitable. So get a different mix in the portfolio. Get more companies that have a robust business model. Look at the commodity sector. Look at these tangible industries I talked about. So that's one strategy. So that's basically changing the composition of your portfolio and then still going for the long term. If you are worried about a correction and you're a little bit nervous about all these negative returns you've had already, the obvious thing to do is trying to hedge the portfolio. And right now we're talking to clients. There are a couple of different ways you can use options. The problem right now is that options are getting very expensive because the VIX level is very high. So it's almost like if you buy put options now, it's like you're buying fire insurance just as the fire broke out in the house. It's a little bit too late. So it probably makes a little bit more sense for investors if they want to lower the risk in the portfolio, that either they can hedge with futures or a CFD index tracker, whatever they want. Don't spend too much time on the put options, they're too expensive. Another way to reduce the risk is to look at the sectors that are less cyclical. So you have consumer staples, which is necessities that people they must own. You also have utility companies as a sector. The telecommunication sector to some extent is part of that. The healthcare sector. So there are these pockets of the market that have less risk when the economy is slowing down.
So you refer to options. Would you also recommend to write call options as a hedge?
Writing call options I don't consider that as a hedge.
I mean covered call options.
I don't think that's. You could do it. I don't think it's really the proper hedging that most investors are looking for in this current environment.
Okay. Many macroeconomic strategists say the recession could be bigger than expected. Maybe there could be a big sell-off in equities, of course. Would you recommend if investor has many large caps and small caps, what would you recommend to sell the small caps first? Maybe they're more volatile, maybe?
So I think I would generally say that we have moved them from a period where you could be long passively the market and almost do nothing wrong for 10 years. I think the environment we're headed into is an environment that is going to be much more about active investing. And in terms of the question between large cap and small cap companies, in an environment where the economy is slowing down and financial conditions are tightening, the large companies have better financing conditions and they are a more robust business model. They're more diversified across geographies. So I think on a general level, I would go with large cap as long as the economy and leading indicators are pointing down versus small caps. But I will say that within the small cap segment, you can still find companies that are insulated. And I think this is a very important point because a lot of investors right now say everything is down. But the interesting thing is that also just like the financial meltdown in 2008 and early 2009, there were still parts of the equity market that was doing well. And we're seeing the same this time around, right? The commodity sector is doing quite well. So my message to investors is actually that, and you can find those in the small cap segment, there will be great companies in the small cap segment that can actually thrive even though the general macro picture is actually quite negative. So you just have to do a little bit more work.
Okay, thanks. You follow the equity markets for a long time, of course, and you said past returns are not a guarantee for the future. But can you maybe call some big investors that you admire? I mean, based on their strategies, maybe like Warren Buffett. Also, because past returns are not a guarantee. But are there some strategies that you think are interesting for investors, also for the future?
So the way we look at it is that. 2 years ago, we started changing the way we look at equities from a research perspective. And we previously had looked a lot on different quant factors, so momentum strategies and value, etc., quality factor, there's a lot of those. And we discovered that it's actually quite difficult to have discussions with investors about quant factors. it's also difficult sometimes to have discussion about sectors even. So what we found out was that themes are a very great way to distill what is going on in the market, but also have these conversations. So we have created an entire universe of different long-term themes. So it could be theme on the hydrogen economy, it could be themes on the biotechnology industry, it could be themes on India, as we talked about. That's a country, but it's a difficult country to invest in. It could be themes on the semiconductor, cybersecurity. So I really think that's one of the key things to think about first. So Warren Buffett is typically pulled forward as that's an admirable investor, and I think his approach to investing is very good. And I think the key starting point is actually trying to find out a long-term theme which is going to thrive over the next 10 years. And then, so personally, I think a theme that I think is super interesting is the cybersecurity theme, because it's still a small industry. It's growing around 15 to 20% a year. It's a counter-cyclical industry because cybersecurity has become a necessity for governments and companies to function in a digital world. So you have this high-growth industry, high return on invested capital, and I think very strong moats in the future. So that's really a Warren Buffett industry, although it's digital, and I know he doesn't like things he doesn't understand. But I'll just say that the cybersecurity is a theme, long-term theme, which I think is a winning industry. And then you have to go into the industry and that theme and find the company you think is well or best positioned to do well.
About cybersecurity, would you also recommend investing in ETFs or just a group of separate stocks?
That's a very good question. There are some good ETFs out there that provides a pretty well diversified exposure to the cybersecurity theme. You could also buy some of the individuals. Of course, it requires a little bit more due diligence. Personally, I think what will happen over the coming 10 years in the cybersecurity industry, that I think there will be quite a significant merchant acquisition wave. I think you will see a consolidation inside the cybersecurity industry because there's some technology changes going on right now in the industry. And also the problems in the cybersecurity industry is getting more and more complex. So I think eventually we will end up with an industry where you have 4, 5 major global players that will basically dominate the market. And that's typically very good for shareholders. So if you have the skills, you can try to find one of those that will be the top 4, the top 5 names in the future. But otherwise, you can always go with an ETF and get the industry return.
Okay, Peter Carney, thanks for the interview.
Thank you very much.